So you've got $1,000 that you want to invest in the stock market but just simply don't know where to start. Well, in today's video, I'm going to help you out and show you what steps you need to take in order to make the best use of that $1,000. How's it going, guys? Ryan here and welcome back to another investing video, and today I'm giving you some tips, tricks and a guide on how to invest your first $1,000 into the stock market. But before we get into that, please remember to give this video a thumbs up if you do enjoy it. It helps me out so much with the YouTube algorithm, and subscribe for more investing, stock market, wealth management and cryptocurrency content. I'd also love to know your thoughts in the comment section below on how to invest $1,000 in the stock market, particularly for beginners. So without further ado, let's get straight into today's video. So first things first, you've got your $1,000. Now make sure this is disposable income and that you have the ability to lose this potentially. Obviously it's your first time investing or trading, so as a result you're likely to make mistakes and invest in companies which may not perform as well as you hope. Obviously in today's video I'm going to try help you out with that, but there is always situations where you are going to lose money, so just to be on the safe side, don't put yourself at risk by exposing yourself to expense that you can't afford to lose. So make sure that $1,000 is disposable and you go into investing willing to lose it. Now let's go into step number one, and this is by far the most important step and the most important decision that you are going to make, and that is what strategy are you adopting. So are you going to invest in something short term, medium term, long term? Are you going to be doing swing trading? Are you going to be investing in dividend paying stocks? Are you going to be investing in growth paying stocks? Are you going to be investing in micro caps which have the potential to explode but also the potential to lose a lot of money as well? This will fundamentally determine your path forward and determine the strategy that you put together. Now, the key thing to keep in mind is pick one strategy to start off with. You've only got $1,000, so you can't overextend yourself. So make sure you stick to one strategy and you learn it inside and out. I highly recommend you do some reading, educate yourself before getting into any of these strategies to work out what is best for you. If you really want to be exposed to low risk but potentially not as high returns, a dividend strategy may be the one for you. But if you're open to a bit more risk and willing to potentially make a lot more money but also potentially lose a lot more money, then you might be wanting to invest in microcap stocks, for instance, which are significantly more volatile. So make sure the first decision you make is what is your investing or trading strategy. Step number two, you need to select a niche. So what do I mean by niche? Well, I'm really referring to more an industry. So focus on something that you particularly understand. So for instance, let's say you have been an engineer in the past. That might mean you understand the oil and gas market, the mining market, the infrastructure market a lot better than other markets such as, technology, weed stocks, those sort of things. Use that experience to your advantage and look into those industries you understand. If you've been in these industries for a number of years, you understand what causes a company to be successful and what causes a company to be unsuccessful in that particular niche. And as a result, you've already got an advantage as opposed to jumping into something that you do not understand. Obviously, yes, it's great to hop into a hot area. So, biotech, weed stocks, those sorts of things. Companies like Tesla, but if you don't understand what you're investing in, then you're putting yourself at a disadvantage. So make sure you use your prior background knowledge to your advantage and select a niche that suits you. Step number three, study the stocks before you buy them. A lot of people unfortunately will go into the stock market and buy a stock, then research afterwards and lose money because they've invested in something that isn't good. You also have a bias towards that stock if you've already bought into it and look for the good things as opposed to the bad things. Whereas if you research a stock before buying into it and don't get FOMO, then you will be having a more balanced decision when you're choosing whether to invest in the company or not. Reverting back to the other scenarios, this is really going to come back to, do you understand the stock? Do you understand the niche? What's your strategy? What's your risk profile? How is this company going to perform in the future? But make sure you research the stock really, really well before you make a decision to invest or not invest in that stock. A great way to do this is through peer comparison. So literally line up all the competitors within a market and put their stats together. Compare their market caps, compare their share prices, compare their earnings, all these sorts of things. And that will help you identify if a stock is undervalued, overvalued, or just about right, and it will help you in your research significantly. You can see what companies are performing well and why, and what companies are not performing so well and why as well. So make sure you do your research and you study your stocks before you buy them. Number 4, if you are really unsure on picking an individual company to invest in, then make sure you check out ETFs, also known as exchange traded funds. And effectively what these are is stocks that are made up of other stocks. That is the most simple way to explain it. So for instance, if you invest in a gold ETF, that means the companies that are made up in that ETF are gold companies. So typically you'll see gold miners in that space. Alternatively, you may go into a biotech type stock. So effectively that ETF, a biotech ETF, would be consisted of medical related stocks. So you can go in, you can really select what you want, and not only that, you can also choose an ETF which suits your strategy, which you decided on at the start. So for instance, if you want a dividend paying strategy, then you can invest in dividend paying ETFs with high yields on that basis. And effectively that narrows down where you can invest, but also exposes you to more opportunity through investing in more companies. So be sure to check out ETFs if you're unsure on investing in individual companies. Moving on to number 5, and this is something incredibly important, especially when we are talking only investing your first $1,000, and that is to beware of commissions. Most brokers will charge a commission, and effectively commission is occurring when you make any transaction. So if you buy a stock, your broker will take a cut. When you sell a stock, the same thing will occur. And typically for a lot of brokers, especially when you're looking at banks, they will take consistent amounts based on the value. So for instance, a broker may charge $10 up to a $10,000 transaction. And if it goes past that point, maybe $10,000 to $25,000, they might charge $20 fee for brokerage instead. But the key to remember here is the brokerage can really eat into your profits. So for instance, if you're investing in a stock with your $1,000 and it goes up 10%, that effectively means you've made $100, right? But you've bought into that stock and let's say they charge you $10 for that transaction. There you go, you've already lost $10. Then when you sell the stock, they charge you another $10. That means effectively you've paid $20. So you've not made $1,100, it's gone down to $1,080. So instead of making $100, you've only made $80 due to the commission. So why do I mention this? Well, it's due to the fact that if you choose a trading strategy, particularly if you're scalping, and scalping is effectively where you buy and sell for pips, and a pip is, you know, if it moves 1 cent up, you buy, it moves up another cent, you sell immediately. That's a pip, and that is also known as scalping. And if you're scalping, that means that your profits aren't going to be that big. So as a result, the brokerage will absolutely destroy your profits. So beware of the commission that they're taking, that brokerage. Now there are other opportunities out there for you where you can engage a broker which does not charge commission, but typically what you'd expect to see is a commission of some form. So make sure you read up on the size of the commissions and the value of the commissions obviously, and see how they're going to affect the transactions that you make before you make them. Moving on to number 6. Don't overcommit to a stock. Don't put all your eggs in one basket. Yes, it is only $1,000, but you don't want to just lose that all at once. So this comes down back to the risk. If you're investing in micro caps and you chuck $1,000 on, you could lose that, gone, easy, because the risk is so high and the volatility is so high. Whereas maybe if you're investing in a blue chip style stock, it's stable, it's paying dividends and that sort of thing, then you can put that $1,000 into that stock. And likely you're not going to lose it all if it does go down, but at the end of the day, you're still putting all your eggs in one basket and you're committing solely to that stock. So that actually moves us on to the next segment. And that is number 7. Don't over diversify. Keep in mind, once again, you've only got $1,000. If you over diversify and invest into too many companies, it's going to dilute your returns. And as I mentioned before, that brokerage is going to absolutely destroy the amount of money that you're putting in. Brokerage for these bigger companies that act as brokers for you is typically quite high when you're comparing it to $1,000 transactions. So if you split that down even more into, let's say, 5 $200 transactions, it's going to absolutely destroy that $1,000 you put in, and honestly, there is no point. So I would suggest a maximum of 2 individual stocks, the only exception being if you're going into an ETF, because that's obviously made up of lots of stocks, but it acts as one stock and you're making a single transaction. So make sure you don't over diversify, but as I said before, don't overcommit when the risk is too high and you're not willing to lose that money. Moving on to my final tip, number 8. The best way to learn is through experience, and I'm 100% serious from that. You can do all the theory that you want to do, but until you actually get your hands dirty and you start investing, that's when you learn. You have skin in the game, you start making decisions that will affect your finances, that's when you really learn. You're going to learn what makes a stock go up in value, you're going to learn what makes a stock go down in value. But not only that, you're going to learn a lot about your investing and your trading psychology. A lot of people get emotionally attached to stocks when they're trading them, which is the polar opposite reason for trading. With trading, you've got to be really focused. You have a set target, in, out, but people get emotionally attached. If you're in a stock long term and it's paying dividends, for instance, get emotionally attached to it. That's fine, but stay rational at the same time. So just get in there, start experiencing the stock market. You'll learn along the way. One of the biggest things I can recommend for you to do is not only talk to other investors and understand their viewpoints, their mindsets, do your own study. There are so many videos on YouTube, for instance, that are free. My channel, perfect example, where you can learn about how to invest, how to trade, different strategies, different techniques, tips, tricks, all that sort of stuff for absolutely free. Alternatively, you might want to invest in, books, that sort of thing. Great idea. But the best way to do this is through experience. If you can combine that experience with the study, then you will succeed in the long term. So make sure you just get in there, you have an open mind, and you are excited and willing and focused on your investment and your trades. That wraps up today's video, guys. I hope you did enjoy it. Please give me a thumbs up if you did, and subscribe for more of this sort of content. Crypto, stock market, investing, wealth management, all that sort of cool stuff we cover on this channel. I'd love to know as well your thoughts down in the comments section below on what you think people should do with their first $1,000 when they're getting into the stock market. So with that guys, I hope you have an awesome day. I'll see you next time. Cheers.